When evaluating a company's financial health, it is important to consider various metrics such as the return on equity, ROE, and the return on assets, ROA. In this video, we will focus on the ROA, which measures how efficiently a company uses its assets to generate profits. Definition of ROA. The ROA is calculated by dividing a company's net income by its total assets. For example, if a company has a net income of rupees 10 million and total assets of rupees 100 million, its ROA would be 10%. Importance of ROA. The ROA is important because it provides insight into a company's ability to generate profits with the assets it has available. A higher ROA generally indicates that a company is generating more profit with its assets, which is a positive sign for investors. Understanding high versus low ROA. A high ROA may indicate that a company is efficiently using its assets to generate profits. However, it is important to consider other factors, such as a company's debt levels and industry norms, when interpreting the ROA. A low ROA may indicate that a company is not utilizing its assets effectively. Comparison with industry averages. As with other financial ratios, it is important to compare a company's ROA with the average for its industry. A company with a higher ROA than its peers may be utilizing its assets more efficiently and may be a better investment opportunity. Limitations of ROA. While the ROA is a useful metric, it should not be used in isolation. Other factors, such as a company's debt levels, competitive position, and macroeconomic trends, must also be considered when making investment decisions. Conclusion. In summary, the ROA is a key metric for financial analysis, providing insight into a company's ability to generate profits with its available assets. By understanding how the ROA is calculated and how it can be used to evaluate companies, investors can make more informed investment decisions. If you like our videos, then don't forget to like and subscribe our channel. Thanks for watching.